Welcome. My name is Barbara Markham. I'm the Director of the Senior Resources Department for the City of Westland. With me today is Gary Allen, who is an elder law attorney. Welcome, Gary.
Thank you.
Gary does a lot of seminars, free seminars at the center to educate our seniors about a variety of different topics. Today we're going to be talking about strategies to save on taxes. And there are a variety of different taxes, so we'll talk about all the different kinds of taxes there are first.
Okay.
Okay, what different kinds of taxes are we looking at, Gary?
Well, the property taxes people have to pay, income taxes. And we're going to talk about inheritance taxes when they inherit money, and the federal estate tax on when someone dies, and then finally gift taxes.
Okay.
So it's different kinds.
All right, let's talk first about property tax.
Yeah, I put that one first on the list for us to talk about because there's a new law that went into effect on December 31st of 2013 regarding property taxes.
Which was just 8 weeks ago.
Right. And so, as most people may know, that in your home, you can file a homestead exemption, and so your property tax value does not grow with the actual true cash value. So there may be your taxable value may be here because you've lived in your home for a long time, but the true cash value may be something that's much higher. Okay. And they may know that if you sell your house and transfer it to someone else, then that person who buys it, who gets the transfer, they don't pay taxes where you are. They pay taxes on what they're paying for it up here. Right. So it can increase taxes a significant amount, 50% to 100% sometimes, depending on how long you've had your property. Okay. And so almost any kind of a transfer would cause these property taxes to what we call uncap. So we say that your taxes are capped. They can't grow. They can only grow the lesser of 5% or whatever inflation is. That's the most they can grow. When they uncap, then the person who gets them has to pay much more. And it used to be that if you transferred your home to a family member, your children, at death, the property tax is still uncapped. So we have a new law that went into effect. It's another exception to the uncapping that says that if the person giving the deed and the person receiving it are related by blood affinity to the first degree, then the property taxes don't uncap. So if you're going to leave your home, what the usual situation is to your children, but it could be to a parent too, or it could be a brother and a sister. Okay. So under the old law, if you left it to those people, the property tax is uncapped, just like they were a stranger. Under the new law, it will not uncap. But the deed, and here's the trick, the deed has to be from a person to a person. And many people have a revocable living trust in which their property is in their trust. Right. And so at death, that deed will go from a trustee to the children.
Which is not first degree relation.
Right. And so they're going to have to pay the higher taxes. Okay. Or if it goes through probate, then the deed will come from the executor of the estate to the person, and the taxes will uncap. And so I'm having to meet with my clients to say, we've got to get your deed out of the trust and get the property back in your name, and then we'll do a ladybird deed from you to your children and so that the property taxes will not uncap. And because a lot of children are going to live in their parents' home after they pass. Yes. So it's important. They could save $3,000 or $4,000 a year by doing this the right way. Okay. Now another piece of this law says that this is only effective for deeds after December 31st of 2013. Okay. Okay. So if there's a lot of people that have deeds that are unrecorded, they've signed a deed to their children, but they were advised by their realtor or by an attorney, don't record this deed. Just kind of sit on the fence with it. And if you sell the property, then you can sell it and tear the deed up. And if you die, then the kids can record the deed, and so then they'll get the property. And so that's true, but that deed, there's a new tax case in Michigan, it's been decided, that deed is effective when it was signed. So if that deed was signed back in 2000 or 1995 or something, even though mom and dad dies after 2013, and it's recorded after 2013, it was effective when it was signed. And so the property taxes will uncap. So those deeds need to be found and fixed.
Okay.
Otherwise, taxes will uncap when it goes to the kids.
Okay.
So that's the significant thing on property taxes at death.
All right. And then now we're looking at income taxes.
Well, in income taxes, I'm not here to talk about how to do your income taxes this
Right.
year. I know April 15th is rolling around, but that's not what this is about. This
Yes.
is a strategies to reduce your income taxes.
Yes.
And I look at income taxes as you have buckets of assets, and some of those buckets are taxable. Like if you have a CD or an interest-bearing bank account or anything else that's paying interest, that's taxable to you, and you're going to get a 1099 and have to pay tax on that. And then there are assets that are tax deferred. So like your IRAs are tax deferred. And so if you put money into an IRA, it grows, but you don't have to pay tax on that growth. If you put money into an annuity, that grows, but you don't have to pay tax on that growth until you take the money out. So it's tax deferred. And then there's some assets that are non-taxable. Municipal bonds, for example, are typically non-taxable for the state of Michigan tax. Non-taxable, if you have money in a Roth IRA, then that's non-taxable. So what I try to do with my clients in looking at their assets is, can I move assets out of that taxable and put it into the tax deferred, or can I move it from tax deferred and put it into the non-taxable to reduce the amount of taxes that they're paying? And for example, you may know that if your Social Security is taxable when you get to certain levels. And so for a couple, Social Security starts being taxed at $44,000. For a single person, it's $24,000. And so if someone gets Social Security and a pension, maybe that hasn't reached that taxable level, but their interest income pushes them over it, and so now they're being taxed on the interest income, and they're being taxed on the Social Security both because they got over the threshold. So we can move that asset from the interest taxable account to a deferred account or a non-taxable account, and so we've reduced the tax on that asset, and we've also reduced the tax on the Social Security.
Now, is this the first year that they actually have taxed pensions? The
Some
retirement?
pensions are being taxed in Michigan that weren't taxed before. Yeah, that was a change in the law.